Welcome to the Farms.com Risk Management Market School video series. As always, you can find us at www.marketschool.farms.com. This video series is being brought to you and sponsored by DeKalb Brand Seed to help producers do a better job of commodity marketing. My name is Moe Agostino. I'm a Managing Commodity Strategist with Farms.com Risk Management. And this video is part 2 of our series where we discuss commodity marketing terms and jargon, where we define a lot of the common terms and jargon that the industry uses. So let's continue with, we left off, I believe, with the F's. We're in alphabetical order here. So we continue with the F's, talking about fundamental analysis. This is the study of commodities' current and expected supply and demand situation in order to help forecast future price movements. So when we talk about USDA supply and demand balance sheets, that's fundamental analysis. See lesson number 5 for more detail. Hedging, to take an opposite position in the futures market to one held in the cash market. Most producers are hedgers. They're long a commodity such as corn, hogs, cattle. So they got to take an opposite position in the futures market to hedge that, which is known as a short futures position. In doing so, one locks in the price a buyer will pay or a seller will receive for a physical commodity. For sellers of futures, the lost revenue from the higher prices after the hedge is established will be offset by the gain in the cash market. The opposite applies to the buyer. Hedge to arrive contracts. This is where you're locking in the futures price but leaving the basis open. A cash contract, but unlike a forward contract, not all the components of the forward cash prices are locked in. Only the futures price is set while the base is left open, and you can lock that in a future date at delivery or sometime before that delivery date. Index funds, large speculative funds that invest on the long buy side, also known as non-commercial traders. In the money calls or put options, if it's a call option, the strike price or call option is below the futures price. If it's a put option, the strike price of the put option is above the futures price. I know this can get a little confusing, so you can see at the money and out of the money calls and puts. You can also go back to lessons number 20 to 22 for more detailed information. Island top. An island top is a technical chart formation that often signals a bearish change in the trend. This formation is established when market gaps higher leaves a price area between the previous high and the new low where no trade occurs, and over time leaves a gap down. The activity creates what looks like an island on a chart with a price bar surrounded on either side by price gaps. Go back to lessons number 20 to 22 for more information. Long, purchasing, buying futures contracts to establish a market position that has not been liquidated through an offsetting sale. It's the opposite of short. Long liquidation. This activity is usually associated with non-commercial speculative traders and refers to this selling of previously purchased long futures positions. Managed money, similar to index funds. In fact, though, they are also very large, control a lot of money, but they can invest both on the long and the short side, the sell side. They're looking to make money whether the market's going up or down. And they're also known as non-commercial traders. Margin risk, the possibility faced by a buyer or a seller of a futures contract that the broker will demand more collateral margin money. This will happen when the futures position is showing a loss. For a buyer, the price is falling. For the seller, the price is rising versus the original purchase or sale price. Go back to lessons number 13 for more detail. The broker will still demand more money, whether the buyer or the seller is a hedger who will get back in the cash market whatever he or she loses in the futures market. Minimum price contract, you can go back to lesson number 10 for this one for more details. A cash forward contract with a buyer of the commodity that works like an option, which guarantees the seller minimum price for the sale of a particular commodity. Moving average, statistical tool used to analyze the market's trend by toning down sharp price fluctuations. So in other words, it just smooths out the ride. You get a lot of the ups and downs, and moving averages basically smooth out that ride. Non-commercial is also known as a speculator, who is a trader participating in the futures market, who does not have a long or short position in the underlying cash market and is not involved in the production, processing, or merchandising of a commodity. Someone who is essentially betting on a price rise or fall to make money. Nearby contracts, the futures contract closest in time, for example, if it's February, then the nearby contract for Chicago wheat would be March, while the May and further out months would be known as deferred contracts. See also deferred contracts. New crop refers to the next crop cycle. Old crop refers to the current crop cycle. Open interest, the total number of futures or options on futures contracts that have not been offset or fulfilled by delivery. Option, a contract giving the holder the right but not the obligation, hence option to buy, call option, or sell, put option, a futures contract in a given commodity at a specified price at any time between the purchase date and the expiration of the option contract. Makes sense to me. I know this gets complicated, so go back to lesson number 19 for more information on options. Options, premium, the price agreed upon between the purchaser and the seller for the purchase or sale of the put or call option, which is returnable. Purchasers pay the premium and the seller's writers receive the premium. Again, go back to lesson number 19. Out of the money calls and puts, you can also see at the money calls and puts, or lesson number 19. The strike price of the call option is above the futures price, while the strike price of the put option is below the futures price. Put option, a contract that gives the buyer the right but not the obligation to establish a short futures position at a specified price, strike price, by exercising the contract. Again, go to lesson number 19 for more information. If the price rises, the put owner simply allows the put to expire unexercised and takes the higher cash price. See also options and options premium. Relative strength index, a technical indicator that relates the size of recent gains and losses as an index numbered between 0 and 100. So when it gets to 70, the market is considered overbought. When it gets to 30, the market's considered oversold. Remember, don't use just one indicator as the end-all indicator. Use a lot of these indicators in conjunction with others like moving average, support, resistance levels. Go to lessons number 20 to 22 for more information. Resistance to price level. The market has had a difficult time moving above due to the placement of sell orders. Acts as a sort of overhead barrier to further price gains. See lessons number 20 to 22. A technical analyst will have a series of resistance points indicated on a chart and will, technical analysts will have a series of resistance points indicated on a chart and will assume that if the price breaks above resistance, it could easily be headed for further gains. And you can, the opposite is support. If we break support, then prices could head much lower. Reversal, a technical chart term suggesting positive price action after an attempt to trade lower, or negative price action after an attempt to trade higher. See lessons number 20 to 22. Scale up selling. This selling of additional portions of a crop either in the cash or futures market as the market price rises in order to realize that price on that portion of production that is covered. So you may sell corn at 7, if the price goes to 7.20, you sell a little bit more, and so on and so forth. You tend to scale up or average up that price. Seasonal index, also known as seasonality, basically is the tendency of commodity prices to rise and fall at a given time of the year. Grain prices tend to rise through the spring, summer, tend to fall in the fall, winter because of that extra supply, that new harvest. Selling futures, to sell futures to make a legally binding promise to sell a commodity at a given price at a given time in the future. If a seller is hedging, he or she anticipates selling the physical commodity in the cash market for whatever price it fetches at the time, with that cash price offsetting the gain or loss on the futures contract to ensure that today's price is what he or she will receive. See lessons number 11 to 13. Short selling futures contracts, or having sold to establish a market position that has not yet been liquidated or offset through an offsetting sale. The opposite of long. See lessons number 11 to 13. Short covering, purchasing futures contracts to offset a short position. See also short, or lessons number 11 to 13. 2013. Spread the price gap between different futures contracts. Support a level where buying interest is sufficiently strong to overcome any selling pressure. See lessons number 20 to 22. Technical analysis, study of past prices and volume data in order to anticipate future market movements. See lessons 20 to 22. Time value, the portion of an options premium that exceeds the intrinsic value. Intrinsic value is essentially the difference between the strike price and the futures price. Trading range, you can also see lessons 20 to 22. Trading range, the difference between the high and low price of a commodity during a given period. Trend, the general trend of the market. Volatility, a measurement of the fluctuation, the price movement of commodity over a period of time, is also a major component used in valuing options prices or premium. Zero-sum game describes the fact that commission fees and bid-ask spreads aside, the gain from a derivative contract from one counterparty is exactly offset the loss to the other counterparty. In other words, there's no winners or gainers. Well, there is a winner and a gainer, but it's a zero-sum game. If somebody's losing, somebody's winning. That is it for this part 2 video series of commodity market terms defined. Hopefully you have a better understanding of some of these terms and jargon that we typically use in the industry. By knowing a little bit more about what these terms mean, hopefully that can help you with your marketing plan. Thanks for watching, and that ends our 2012 Market School video series. We hope that we've provided you with some insight for 2012 as we move into 2013. Until then, we look forward to seeing you in 2013. Again, if you have any questions or discussions, feel free to call or email me at the email and numbers provided below. Happy New Year to everybody. Take care.